Hello traders, welcome to Nimbus Capital bi-weekly update where we go through general updates on current market condition, performance, and certain noticeable stocks and our views on them. We are currently in the final week of January 22, and what a crazy week it was for the US market. The S&P 500 dropped 5.8% on third week of January, even though it only has 4 trading days due to a US holiday on 17 Jan, which was the Martin Luther King Jr. Day. The Nasdaq dropped even lower for that week at 7.3% due to higher tech weightage, and the Dow Jones faring slightly better at 4.8% drop due to being less tech heavy. This is something that we have shared back in the previous update video. The price action for US market was even crazier in the following week from 24th to 28th January. The S&P 500 went sideways between the low of 4,220 and the high of 4,455. This is a whopping 230 points range. Consider that in the previous week, the price went down 270 points in one direction. Within 27 and 28 January itself, the S&P 500 moved close to 1,500 points within the mentioned range. Even during the sharp V-shaped recovery of the post-COVID-19 period in 2020, the S&P 500 took 253 days to make that 1,500 points. This level of price volatility is almost unseen since 2008. This is also one of the biggest reasons why we advise traders not to bottom pick the market during the week, as the huge directionless movement will most likely whip traders with leverage off their position. And this is twice as true for traders who are trying to perform any form of emotional revenge trade from the previous week tech sell down. The huge volatile week that accompanies a market sell down is also known as the account blowing week, where retailers who try to bottom pick get blown out by this extreme volatility of the market and end up ending their trading careers. There are a few contributing reasons to this craziness in the US market, which seems to be absent from both the Singapore and Hong Kong market. Firstly is, of course, the expectation of the Federal Reserve hiking the rates. Based on the FOMC meeting minutes, we went from an expectation of 2 hikes in 2022 to as high as 5 hikes. While the hike itself have not materialized yet, the market is already pricing in the eventual increase in the rates. This is best seen in the tech sector, where majority of the companies are high revenue growth but loss-making in return for future cash flow. With the threat of rising rates, the future projected cash flow have to be discounted for the higher rates, which means less future profit, which leads to drop in the share price. The most impacted companies are those unprofitable companies that are still in the revenue growth phase. Some of these companies such as Fiverr, Lemonade, Peloton made their highs as early as July 21. Palantir, DoorDash, CrowdStrike, and Snowflake follow later with their high at September and November 21. Now, for the tech sector, market have proved that profitability is not only mandatory, but the company must be able to grow and is also resilient to future economic headwinds such as global supply chain disruption among the top concern. Even the big names mega cap tech companies who have shown consistent profitability are not spared. As the earnings report rolls in, market not only expect tech companies to beat the earning estimate, but also provide evidence of future growth. We can already see a bit of divergence in the mega cap tech company as well. Traders and investors not only need to pay attention to the numbers, but also to the press release for future growth guidance during the earning release. This brings us to the second cause of the volatility and sell down for the past 2 weeks, the earnings season. While tension and panic from rate hike expectation is already in full effect, the company's earning report is just adding fuel to the already burning fire. At the time of making this video, 30th Jan 22, Netflix, Microsoft, and Apple have already released their earning reports. While all three companies beat their earning estimates, Netflix reported a 50% decline in subscriber numbers, which is seen by the market as negative future guidance. Apple and Microsoft, on the other hand, not only beats the earning estimate, but also provided future positive guidance, with Apple stating that they are not really affected by the chip shortage and the supply chain disruption, and they will continue to deliver. What is interesting is that we can see the price divergence of Netflix from Apple and Microsoft as early as late November. While this is seen in hindsight, it does seem like smart money has a clear clue of what was coming ahead. With the earning report of Google, Amazon, and Facebook coming up next week, maybe we might already have some clue of what the future guidance will be on these companies. However, please take note that these are not trade ideas or trade recommendations to speculate the price on the date of the earning release. On the chip maker and the semiconductor side, we see most of them has fallen from their November high. On the longer term perspective, all these companies are still overall positive for 2021, and they have yet to break their crucial support that was formed in October 2021. From investor perspective, lower prices might sound attractive, but we highly encourage short-term traders to avoid these counters for now. The banking and the finance sector did survive relatively well compared to the tech and semicon sector. Much like the tech sector though, beating the estimate was not enough, as any negative guidance can cause the price to underperform compared to its peers, as we can see evidently from Citigroup and JP Morgan performance. Unlike the tech though, the economy type is in the favor of the banking sector and they do not have a steep slope to climb. Aside from the underperformers, most banks are doing well overall, with price maintaining above the 200 moving days average, and a short-term support are still holding. Let's look at the energy sector next. It is no doubt that energy sector is highly correlated with the oil prices, but it is also a sector that does well in the rising rate and rising bond yield environment. Unlike the bank sector, we have two tailwind factors favoring majority of the energy companies. Chevron missed their quarterly earning estimate on Friday, but what you will notice for most energy companies is that they were loss-making during 2020. Being positive in terms of net income in 2021 is considered a huge win for the sector as a whole. Hence, the market is much less forgiving to missing the estimate. Chevron managed to hit an intraday all-time high at 137 on Thursday, when the majority of the market have fell 20 to 30% from their highs, and it still managed to close slightly higher than its opening price upon missing the earning estimate. Other energy companies such as Exxon, Marathon Petroleum, and EOG Resources have still yet to announce their earnings, but we would expect similar price action compared to Chevron. Before we move on to the Singapore and Hong Kong market, let us wrap up the US market first, since it is the most volatile market for the past 2 weeks. Currently, we are seeing an overall shift in the market trend from everything is up to only a certain specific sector with an economic tailwind is going to survive. While we have enjoyed a sharp V-shaped recovery from the COVID-19 low in 2020, this trend has come to an end. Going forward, we will see a more subdued uptrend, much like the 2015 to 2018 price movement. Does this mean that we should avoid trading or avoid the stock market altogether? Definitely not, because as trader, we have to be more picky in our choice of trade, and we should also maintain a balance of both long and short positions. Ideally, we will want to long outperformer in a sector that does well in this new environment, and short underperformer in a sector that has a steeper slope to climb. This also means that blindly placing long position on index will not provide attractive return compared to the 2020 to 2021 period. Overall, stock market will still go up in due time, but our trade strategy have to shift to this new environment. For the US market, we have provided a bit of hint on what are the sectors that can do well and what are those that will not, and how to identify outperformer and underperformer. If you wish to learn more in details about the overall portfolio management, specific stocks and sectors to look at, you may consider joining our Patreon because we recently did a webinar on this topic with our fellow subscriber. Now, let's move on to the Singapore market. The Straits Times Index is still trading close to its 52 weeks high at 3,300. Definitely not affected by any form of tech sell down that we have seen in the US or even in the Hong Kong market. This is because the index is heavily weighted on the bank sector, which is holding up very well. The danger here is that if the banks decide to do a short-term correction, the index is going to fall as well. The rest of the index is either underperforming or they do not have the weightage to affect the index in a meaningful manner. Many of the non-index components that outperformed the market in 2020 to 2021 have started to fall or have already fallen. Companies such as Grand Venture, iFast, Propnex, Union Gas, Franken have fallen from their highs and broken their key support level. While we have successfully traded this company through mid-2020s, we no longer have any open position on them. The tradability of Singapore market truly does depend on these mid-cap outperformers, as the large cap index company are too stagnant to trade. Most of the penny stocks in Singapore have also been stagnant for a very long time, and trading these penny counters are often not recommended as you need extreme precision on the entry and exit. Otherwise, you risk missing a one-time exit window as the shares plummet, and you might end up holding onto a penny stock that might not move again in years. Even if they do eventually move, they might not reach the previous high. Capital earnings show some form of optimism, but the closing price is slightly disappointing given the huge improvement in their profitability. In terms of technical, we still prefer Sembcorp industry much more to Keppel. Without the mid-caps moving, the tradability of Singapore market decreased tremendously. It becomes more of a trader and investor choice of flight for safety to REITs and dividend counters. Even then, we have to be mindful of the underlying economic condition, as REITs also tend to have tendency to reduce their dividend payment if they are not performing well. However, all hope is not lost though, because much like the US market, we do have certain sectors and companies in the Singapore market that we are looking to short. And there is one company that could make a new 52 weeks high that we are looking to long in this new current market environment. We will slowly reveal these counters as the price action move in favor of our trade direction. Honestly, we do not have much comment on update on the Hong Kong market because as traders, we have been avoiding the Hong Kong market since the mid of June 2021, and we focus our trade on the US long position during that period. Even until now, there is not much improvement in the overall Hong Kong market. One thing we wish to point out is that during 17 to 21st of Jan, Hong Kong market went up while the US market began its tech sell down. We have cautioned traders who lost money during the US sell down against blindly running to safety in the Hong Kong market. A few days later, we do see the Hang Seng Index creating a lower high as well. Trader might make this rash decision as during the same week US is in talk for the rate hike, China actually cuts the rate. So this can be seen as an emotional trigger for traders to blindly running into the Hong Kong market, but we have to be disciplined during this time of volatility. As traders, it is very important that in times of portfolio drawdown, we do not make any rash decision to revenge trade. Trading is not as simple as A equal to 1. It is more like A plus B plus C plus D, maybe 70% chance of being equal to 1. And most of the time, we might not have the information on what is B, what is C, or what is even D is. We are always trading with incomplete information, and that is why discipline and risk management is very important. The Hong Kong tech counters also have fallen from their lower high as well. Hong Kong tech sector might have fallen into the deep value category, but as traders, we will be looking to avoid the market and the sector for now. On the other hand, despite the rate cut, HSBC and PSBC are making 52 weeks high, and these counters have appeared on our Nimbus Capital scanner on the 5th, 7th, and 10th of January. The scanner is shared daily around 5 to 6 p.m. So do take a look. We will provide the link in the YouTube description. If you have survived the US sell down with less than 20% portfolio drawdown, you are still doing pretty okay. If you manage to stay calm, avoided revenge trading during this crazy volatility of 24th to 28th January, you have avoided a potential account blowing moment and you are showing great discipline. Now, moving forward, it's time to prepare and get ready for the new market dynamic and recover. We hope that our update helps you in your trading journey. If you wish to have more in-depth information on how to manage your portfolio, trade ideas, and more in-depth market update, do consider joining our Patreon. Our 3-month trading course in March 2022 is also going to commence soon, where we provide coaching style method of teaching and trading the live market instead of information dump. If you are interested, you may consider registering as well. Once again, links are in the YouTube description. So thanks everyone for tuning in and stay safe.